Well, hello there, ladies and gents. Great to see you again, and welcome back to Path to Abundant Living. Ryan Ruff here, your moderator, but as always, I'm joined by the fellas in Scott Morrison and Matt Nordman of Morrison Nordman Wealth Management. We got a really interesting discussion that we're going to be jumping into today. I know we've had a lot of guests on the show of late, but we're going to get down to brass tacks here, back to a wealth management related discussion on the show. Something that Scott and Matt and I were just talking before we pressed the record button today. It's something a lot of folks should be focusing on here in today's day and age. Really, the whole gist of today's conversation is going to be surrounding this idea of tax loss harvesting. We're going to be talking about what it is, what it means for you in your financial world, and ultimately why it matters, why you should be focusing on it here and now. So with that, let's go ahead and bring the guys on, say hi, and then we'll get into everything. Scott, Matt, good to see you guys. How are we doing this morning?
Good morning, fellas.
Morning, Ryan. Scott, as always, great to see you both.
Yeah, looking forward to today's discussion, guys. I know this is a topic we've been wanting to hit for a little bit, just given the increased level of conversation surrounding it among you and your clients. Scott, why don't you frame things up for us, tee it up high, and give our audience kind of an overview on this idea of tax loss harvesting?
Sure. I think the one thing I can speak to is the uncomfortableness of having a phone call from a client, especially in a year like 2022 or right after they get their statement at the end of the year when the market has not performed well. They're all I've read about is the doom and gloom of all the interest rate hikes and what's going on with the bond market. And here they are looking at their statement and seeing, it being down 10, 15% or more. And then having that pain, as if that's not enough, have it compounded a couple of weeks later when they receive a 1099 that says they have taxes to pay on capital gains and or dividends that were paid inside of an account that on paper has lost money from one year to the next. So, that's kind of the theme of today is, it's not as much prevalent in accounts where, our clients are investing in IRAs or Roth IRAs or employer plans, because those are all qualified accounts that, the taxes are deferred and or tax free. But for those people who come to us who've said, hey, I've maxed out all of my investments on the qualified side and I'm looking to save more, this becomes a real issue. Not only what the clients are hearing in the media about, keeping fees down, but not spending a lot of time talking about how do we tax manage accounts that aren't tax deferred or tax free, by the IRS rules.
So what you're saying, Scott, is people should care about taxes?
A little bit. Yeah, absolutely.
Along with what you were just saying, there has been I don't want to say a big push, but we are all taught, hey, it's low cost, free, low cost, which is important. But I know we're going to talk about this in detail and you're going to jump into it real quick here, but that's that whole idea of how much do taxes really eat away at your gains each year, and is there anything that can be done about it? And we have so much great information. I had someone stop in this week and said they had seen something on Twitter, and as he said, he's like, well, you can believe everything on Twitter, right? And it's like it's same thing with TikTok and Instagram. And the good news is there's so much information out there. The bad news is there's a lot of information out there and a lot of, as we know, misinformation. And unfortunately, there are people who are out there that, believe it or not, have their own best interests at heart. So they're not necessarily looking out for you and your well-being when it comes to your investments.
Right. Yeah, and I think that, when you think of some of the other trends over the last few years, you think about what's been promoted in terms of like the index funds being tax, that they're tax friendly to begin with, because there's, in a buy and hold kind of a fund like that, you don't see any kind of transactions going on. So your 1099s are less. But the problem is that with that index fund, you don't have the same kind of professionally managed account that you would need. There's still embedded gains there that we have to contend with, but they're just not showing up in a 1099 each year. And so a lot of that's getting passed on. You think about some of the largest mutual fund companies you can think of, And you think about some of those really old funds that you buy into and not realizing that what you bought into are all the embedded gains that have yet to be paid out. And maybe Matt, what you can speak to is, how does a fund, a fund manager, for example, how does somebody who owns a fund have any kind of control over what's going inside that mutual fund when there's a bad market going on and a number of people are calling into that fund manager saying, "Hey, move me to cash." What kind of pressure is that fund manager under?
Well, it's a great question. So fund and fund managers have, for lack of a better term, their own agenda. If they say they're a large cap fund or small cap fund, meaning they specifically what they're supposed to invest in, we won't delve deeply into style drift, meaning, well, I thought I was buying a large cap fund when in reality it ends up investing across many different asset classes. But so with the fund manager, they have an objective, and their objective generally is to make money and beat a benchmark. It doesn't necessarily mean it's going to be in your best interest, right? So you have your money invested, for instance, Ryan, invested in this fund, and you think, okay, this fund manager is looking out for my best interest. Well, not necessarily. They have an agenda of their own. And so, like Scott was saying, if there's a big event, and we as humans are very emotional, especially when it comes to money, and a lot of times you'll see if there's a big event, there's a big push to liquidate, and people, for lack of a better term, sometimes panic and they say, okay, I got to move my money to cash. And in that event, that fund manager says, okay, I have to raise a bunch of cash because people are going to be redeeming their shares. Well, maybe they bought Microsoft stock inside this, the fund manager did, and there was a big gain. They bought it for, $50 a share 20 years ago, and now it's $150 a share. Well, when that gain is going to be passed on to all shareholders, whether you were the one that you said, hey, you know what? I'm going to ride this out. This is a short-term blip. It's an event that's happening. I'm okay with it. Well, it doesn't matter because that fund manager has to raise cash and sell off a lot of positions because a lot of people are calling in needing money. And as a result, there's going to be capital gains on those shares that you have no control over. And so
I think what a lot of people don't realize is that in each mutual fund, even the index funds, there's a cash position. And that cash position is there so that there can be redemptions and contributions or investments made into and out of the fund. So in those crazy events like a pandemic or an election year where things didn't go exactly as the investor planned and feel the need to react emotionally and call that fund to say, hey, move. If enough of that happens, if enough of those redemption requests occur and there's not enough cash in the fund, then the money manager he has to sell some positions, even in an index fund, which then in turn gets passed on to anybody who owns that mutual fund.
Well, so it's not, you talk about index funds, which are the term passive, right? Index, or professionally managed or active funds. It's not only if people call up for redemptions, right? If there's a rebalancing of the fund, if they say, hey, you know what, we're getting too overweight, too much of a position in one particular company or one particular sector, or one has done really well, they're going to, rebalance the portfolio, i.e. sell off positions, which can create a capital gain. And like you said, 95% of those gains have to be passed on, regardless of whether the fund overall is making money. If there's internal gains in there, they have to be passed on. And as a result, like you were saying, Scott, we've seen it in our careers where people come to us and say, hey, I had this fund over here with this advisor or whatever, or on their own. And they're like, I just lost money. Why am I paying taxes when I lost money? Like, how does that work?
Right. Well, and that's kind of what, when we start talking about tax loss harvesting, what are the things that typically someone will do if they go to their CPA, for example, at the end of the year, and the CPA says, hey, let's do a little bit of a test run, or kind of do a return to see what can we forecast your tax return to look like. And if it turns out that they say, hey, there's going to be some significant capital gains to address, it might be too late in the year to actually do anything about it. Because if the market's not in a place where you could sell off something, because a lot of times we'll get, Matt, you and I have taken those phone calls where the CPA will say, hey, is there any losses somewhere in this person's portfolio where we could sell something to create a loss to kind of offset some of these gains? And while that's a great strategy, it's kind of the basis behind tax loss harvesting. The timing of it becomes very, dependent on what the market's doing. And you can't always assume that the market is going to be in the place it needs to be in at the end of the year to do that tax loss harvesting.
You mean the market doesn't move in one direction, either straight up or straight down? Is that what you're telling me?
That's exactly what I mean. And and I know now that we've done a lot more separately managed accounts with the kind of professional management that does the tax loss harvesting. That at any given time in a year, even a good year, there are drawdowns in that year where if you're very
wait. Explain a drawdown.
Well, you might, for example, in 2018, I'm just looking at a chart here, or 2019, there was a 29% overall gain on the S&P 500 in 2019. And yet there was a 7% drawdown at some point during the year.
Drawdown meaning the market was down.
The market was down 7%. Okay. So even in a good year, there was that kind of volatility. Now, if you're waiting till the end of the year to look for that loss, it might not be the right time, because that market could have been something that at the end of the year really took off. So you want to have the kind of tax loss harvesting strategies going on throughout the year so that you can take advantage of whatever drawdowns might be occurring during the middle of the year or even at the start of the year.
Right. So explain specifically, get in the weeds a little bit. What is when the fund manager or the advisor and the CPA and everything are working together, how does tax loss harvesting work? Like what does that mean?
Well, essentially, you think about your portfolio, and if it has, let's say, 50, I'll just use it, round number, let's say it has 100 stocks inside of it, and 3 of those stocks are down at a given time, and we see all of these potential gains. That might be even gains that were inherited from an account that was transferred from one place to the next, and you're trying to figure, okay, at the end of the year, we can anticipate that this is going to be a problem. So can we strategically look for stocks that are down at any given time to sell those to create a loss? Now, for some people, the knee-jerk reaction is, yeah, but if I get out of the fund or get out of the stock or the fund while it's down, and then it goes through a recovery process, well, now I've missed out on the rebound, right? And then we have all these rules called wash rules about how long you can't just sell a stock and then repurchase it immediately. The IRS has an issue with that. So they have a specific period of time that you have to wait to repurchase a stock. So what do we need to do if we want to sell something? Well, maybe what we want to do is look for a like stock, something that's very similar, same sector, and we want to buy into that stock. So we've sold one at a loss. We've bought another one that if that sector is down, we've probably bought another one at a low point. And if the rebound occurs, we're not in cash. We're still invested. So in that respect, we've recovered the loss, but it's not a taxable event because it's still on paper. All that's happened is the share price has gone up, and we don't get taxed on the shares going up or down.
So for instance,
what we get taxed on is if a dividend in that stock occurs, or in the event that we buy or sell something and actually create that gain or loss.
Right. So for instance, you own Home Depot, and the building sector or DIY sector is doing really well, but there's an event that occurs and a lot of the sector is down. So you take that loss in Home Depot and then you buy Lowe's, for instance.
Exactly.
Yeah. And I can give an example. So in 2023, I had a client call, and he's purchasing a home. And so he needed a down payment. Well, at the time there was roughly about $250,000 of gain in his account. And we had enough time from when he needed the withdrawal through the end of the year that it was going to be $100,000 capital gain by him taking that withdrawal. Well, as it turned out, because we had enough time and we worked with the team, come January, early February, he got his 1099 that actually showed a $15,000 loss. Some of it was long term, some of it was short term, zero capital gain. And
Right.
that's how tax loss
And a
harvesting,
statement that was very positive.
and a statement, exactly, and a statement that was very positive. And so
So
imagine, right? So wait a minute. So I took my withdrawal and had this gain and didn't have to pay taxes on it. Sounds good to me, right?
yeah,
And to most people, it does.
right.
Sure. Fellas, quick question for you. I mean, the common theme, not just in this conversation today, but across a lot of episodes that we have, is working with that team of trusted professionals, getting the expertise from a lot of different, folks, and being able to work together to efficiently manage your financial world. I'm sensing that is most certainly a theme here when it comes to tax loss harvesting. What do you say to the person that is trying to do it on their own, shall we say, or just working with that one fund manager? Is there anything that they could or should be doing to maybe start implementing some of this tax loss harvesting strategies into play?
Short answer, yes. Is so it's one of those things, right? What is it? Mark Twain said, and I've changed it. Mark Twain said, we're all ignorant. It's just in different areas. And I don't like to think I'm ignorant. So I just say we're all smart. It's just in different areas. And if you want to take the time and effort to educate yourself on all these different areas, by all means, there are a lot of resources available. But for most people, they don't want to do that. I use the analogy, and Scott's heard me say it 1,000 times. I could probably figure out how to change the oil in my car, and I could probably do and have done some minor auto repair things. And I don't want to do that anymore. I have the expert who takes care of the vehicles for us. And I always joke, hey, it might need blinker fluid. I don't know. Right? But having those experts for those areas that you are not an expert, learn. I'm a big believer in learn as much as you possibly can. But this is a one-time thing for you, whereas that expert is dealing with this every single day and is on top of all the different laws and strategies that are available to you to take advantage. There is no such thing as a loophole. People talk about, so, the loophole. Congress passes laws for a specific purpose. They believe it's only that purpose. Then someone else has figured out, oh, wait a minute, it can be used for these 3 other areas. Now, we can debate whether those things should or shouldn't be, but there's a reason that things are the way that they are. And so, hey, work with that expert who can help point out these different strategies for you, unless you're really inclined to become the expert in all those areas yourself.
Sure. And I think it's safe to say loopholes are usually short-term solutions, right? To quickly get around a problem. Whereas what we're talking about, tax loss harvesting, these are issues. And Scott, you had mentioned a moment ago, it takes time. You need the time to be able to catch this and then go through a series of who knows, weeks, months, to be able to actually implement some of these changes so that you have a scenario like your client there that didn't take, had a very positive overall of the year, but ultimately didn't have those capital gains.
Well, when you think about, I was going to say, when you think about a real-time event, it sometimes it happens at within a moment that you have to take advantage of that moment. And obviously the professional is the one that's the money manager, so to speak. If they're implementing tax loss harvesting as part of their objective, they're looking for every opportunity at all times of the day, at all times of the year. Whereas I can think of a young person who wants to buy stock on their Robinhood account, which is great. It's fine. But understand that if you're in the middle of delivering a lesson to your classroom as a teacher, you're not going to step out necessarily without getting in trouble to, trade that stock thinking that, hey, I have this opportunity to do some sort of tax loss harvesting. I mean, that's where you've got to, there was that saying, price is only an issue in the absence of value. Well, absolutely, you want to make sure you're not paying fees where you're not getting any value. But if you're paying a fee where it can translate into a 2 or 3% effective gain, by having tax loss harvesting, if we can say, hey, that's your tax alpha, that's your return for doing tax loss harvesting, then if I can get 2, 3, 4% as a return off of that kind of strategy, can I justify paying 80 basis points as a fee to the sub-advisor who does the tax loss harvesting? Those are the kind of things where you start weighing out, is the fee worth it?
You have to look at all the fees, and what many people in the media, not to generalize, but it's out there. It's like low cost, no fee, right? There's many companies with, Vanguard is one of the most famous for low cost or no cost funds, which is great. But is there an issue in potentially this tax alpha, right? What is it that you may be missing out on? And on average, like Scott was saying, that it can be upwards of 2 to 3% a year. There was an article a few years back about the real cost of owning mutual funds. And again, mutual funds are great. There is nothing wrong with them. What is your objective when investing money? And so, but it was when you start looking at that tax cost is what we're referring to. And then there is a cash drag. Does in those times where, hey, there's that event that occurs and you get all these redemptions, well, that fund manager has to sell off a lot of positions and put the money in cash for those redemptions. Well, if money's sitting in cash, it's potentially not making as much as the actual investments, and so you have that drag, and then there's trading costs. And people say, well, if you have an actively managed fund or even a passive index fund, there are still trades that are occurring inside of there, and what are those averaging? And so when you start looking at all those internal costs that you don't see those on your statement, right? And that's where people say, well, I don't pay anything, this is, it's free. Well, someone, in my family will say, if it's free, I'll take three, right? But in reality, how much in life really is free? Most people don't do their jobs for free, and fund managers don't do their jobs for free.
Mm-hmm. Yeah, that when you look at a fund or the prospectus, you're certainly going to see, okay, is there a sales charge? Are there surrender charges? What's the expense ratio? Those are all the things that are very transparent, to the investor. What's not transparent is the effect of the taxes. If there's that kind of turnover, one of the things that people don't look at a lot is if they see portfolio turnover of 100%, 200%. Well, now you're talking about owning completely different investments than you had at the start of the year. That's a pretty good indicator that something is happening on the tax side of things, and that isn't necessarily going to be translated on your statement. It's just showing up as a lot of trades. So at the end of the year, you're just kind of surprised by the fact that this all happened and didn't have a lot of control over it because your money was commingled with a lot of other people's money.
Like we talked about, it's that pooled investment. They take money from all the different investors, put it into a big pot, and then buy a lot of, depending on the objective of the fund, whether it's U.S., international, big companies, small companies, are there going to be fixed income, i.e. bonds in the portfolio, and what's the objective? And so again, the fund manager is building a portfolio for the fund, not specifically for, in this case, for you, Ryan, right? We're building the portfolio for you and your family versus for the masses. Mm-hmm. And so again, nothing inherently good or bad about mutual funds. It's just, what is your objective, and does it make sense for you to put money in A or B for what it is you are trying to achieve?
For right. And that's where we found that, a separately managed account, or what they call an SMA, has great advantages in that regard, because a lot of them are invested in individual stocks, but they're in your name. It's not in the name of the fund. It's not where you own shares of the fund. You own those shares of that stock. So anything that's done within the fund or within the portfolio itself is with you in mind, and not all of the account holders. And so if there's a significant event going on and you have the discipline to get through it, and say, hey, this was money that I hadn't intended to use for another 10 or 15 years anyway. I expected, a recession here and there, or I expected some sort of a geopolitical event, and I understand that that's going to happen. I would like to have that kind of control over my account, as opposed to putting myself at risk for what everybody else is going to do.
Sure. Well, quick question for you guys with regard to tax loss harvesting is Is there a particular time of year that is maybe the best moment to be looking for some of these opportunities, or is it more of an ongoing process? What's your thought on like kind of the timing of everything?
So short answer, yes, all 365 days, or the actual trading days, because like Scott said, there is volatility from day one through the entire year, right? Even in years of 2022, which was down, the entire year was not down. I mean, for overall it was down, but there were times during the year where there were, you know, up markets during that time. And same thing in 2023, which was an up market. It didn't go straight up from January to December. And so there are, that's where having that team in place, unless that's what you want to do all day, having that team in place that is looking out for you. And you could say, so for instance, we're transferring, some client accounts to a separately managed account, but there were a significant amount of gains that this person, it's money they don't need for a while. But with the investment team, we can spread those gains out potentially over 4 years. So you're not getting hit with this because they know they're going to need the money, a little bit down the road, but they don't want to take a massive tax hit. So the plan is to spread it out over 4 years. It doesn't mean it will, because we had a plan a few years back where the plan was to spread it out over 4 years. And it ended up being within 2 years with the team that entire gain was gone. They had still had gains, but there were no capital gains that they were going to end up paying because of that tax loss harvesting that was done throughout the year. So there is no specific time, but like Scott alluded to earlier, Ryan, is many people get the call or meet with the CPA at the end of the year and say, well, it's December. Should we do any tax loss harvesting? Well, you may have missed that window.
Got it. Thanks for clearing that up. Appreciate it.
Yeah. Yeah. I think too that, kind of going back to one of the things you alluded to earlier, Ryan, about the team, having the team, what's, the importance of having the team. If you're collaborating with the other professionals ongoing, having those regular reviews. We meet with one of the sub-advisor relationships that we have on a quarterly basis. And we know what they're going to do with the portfolios before they do them. They get our approval, to do those things. We know how it's going to affect our clients before those decisions are made. Unlike in a mutual fund, a very large mutual fund where I have no control over what that manager does. So it gives me an opportunity to then consult with the CPA to say, hey, this is what we're thinking about for client A. What are your thoughts? And, then the CPA can certainly give their feedback, and we can look at, well, maybe not now, but maybe next year. Or what if we had a big capital loss, for example, one so big that we can't take advantage of it fully in this next tax year? Well, maybe we can spread that out too. So it's that kind of conversation you can have with the CPA or the attorney, estate planning attorney, if we're talking about, the taxation on selling a business or something like that. Having those kind of ongoing relationships, so to speak, that virtual family office that we've spoken to before. Those are the kind of things I think this is where the industry is going. I certainly think that's where, as a client, where I'd want to be putting my efforts, is to find a firm that offers that kind of well-rounded service. And I think that's where, a lot of what we've learned over the years is by the fact that we've sat down often and used clients as a case study with other professionals and arrived at, hey, this is really the best relationship you can have.
Well, guys, I mean, the concept as a whole of tax loss harvesting, it's definitely a concept that isn't, top of mind, shall we say, within routine conversations surrounding somebody's portfolio, or rather their entire financial world. And given the conversation today, where there are so many ins and outs, it is an ongoing process that is something that should be looked at almost every trading day. And it's undeniable that somebody should be having a team that's looking at this for them and with them and getting their feedback along the way. For somebody out there that's hearing all this and they're thinking to themselves, man, that sounds nice, or geez, I need to be focusing more on this, or I need to make sure my team is focusing more on this, and they could benefit from that stress test or that second opinion, or just even having a specific conversation about tax loss harvesting for themselves. what would be the best way somebody could open up a conversation with you guys and talk through your process and see what that all looks like on their end?
First, if you use your computer, go to our website, morrisonnordman.com, 2 N's on Nordman at the end. And there you can click on schedule a get to know you call, or even if you want further, you can schedule even a longer meeting. Or the traditional way is call the office, 517-333-7967. Talk with Rose, Jill, Mike, any of us to schedule a call, and we can walk through what makes the most sense for you in your situation.
Fantastic. Well, guys, I appreciate you and your time. I mean, any final thoughts, any final things that we want to leave out, or maybe that we didn't cover?
It is important to take a look at the entirety. Yes, fees are very important. We want to keep fees as low as possible, but also understand it's kind of like when we ask the question, what's the biggest risk people face when investing money? And invariably, 99% of people will say losing it. And losing money is a risk. There's also inflation risk and currency risk and opportunity risk, right? So you have to look at it. And the same thing with this is tax loss harvesting is one piece of the entirety of your portfolio. So take that look at the entirety, not just so focused on, well, I own this super low cost fund and it's doing everything I want. Well, is it really doing it? And so that's where you would, reference the second opinion or the stress test to really take a look at the entirety of your plan.
Fantastic. Well, guys, really appreciate your thoughts today. Really good conversation. I think it'll leave folks with a lot of considerations for their own financial world, of course, but appreciate your time and looking forward to being back here on the next one with you.
Thanks, Ryan.
Thanks, Ryan.
Scott, see you soon.
All right. We'll see you later.
All right. Thanks, fellas. And hey, folks, we're going to take a final moment as we typically do and thank you for making us a part of your day. If you enjoyed today's discussion, you learned a thing or two, I know I did, make sure you hit the subscribe button on whichever platform you checked us out on today so that you don't miss out on any future conversations between Matt, Scott, and myself, where we dive into these wealth management topics, or where we bring on one of our esteemed guests and, take a page out of their playbook, dive into their unique expertise in their world. But either way, we do this for you guys. We want to make sure you enjoy the content moving forward. So make sure you hit that subscribe button. But we appreciate you guys stopping by and being with us here on Path to Abundant Living. For Matt and Scott, I'm Ryan. We'll see you next time.